We are living in an era where what once seemed impossible can become reality overnight. And today, as Bitcoin, the most powerful symbol of the decentralized financial revolution, officially surpasses $103,000, an all-time high, the financial world once again finds itself asking the familiar question: what is really happening, and what lies ahead? This is no longer a temporary price spike like those seen in 2013, 2017, or 2021. This is a new wave, deeper, stronger, and more solidly grounded. What's happening is not just the surge in value of a digital asset, but a global shift in perception about value, asset control, and the future of the financial system. The reason behind Bitcoin's current rally cannot be explained by a single news headline or a passing event. It is the result of many accumulated factors over time. Shifts in monetary policy by major powers, geopolitical tensions, the entry of financial giants, and fundamental changes in global investor behavior and perception. 10 years ago, Bitcoin was associated with risk, uncertainty, and even scams. Today, it's included in the portfolios of the world's largest financial institutions: BlackRock, Fidelity, JPMorgan, Goldman Sachs. Organizations once skeptical of crypto are now not only accepting it, but leading the investment wave. This marks a turning point of recognition. Bitcoin is no longer virtual. It's a real asset, valuable, liquid, and with the potential to become a store of value similar to gold. The most important milestone in this transformation is the U.S. Securities and Exchange Commission approving spot Bitcoin ETFs. This is a historic event, as for the first time, retail investors in the U.S. can access Bitcoin as easily as buying a stock on an exchange. Previously, owning Bitcoin meant facing the risks of cold wallets, unsecured exchanges, extreme price volatility, and lack of transaction transparency. But with ETFs, everything has changed. Liquidity surged, capital flooded the market, and Bitcoin's price responded immediately with relentless upward momentum. Alongside the ETF development, global monetary policy has played a key role. After a prolonged period of massive money printing to stimulate post-COVID-19 economies, central banks, especially the U.S. Federal Reserve, are grappling with rising inflation. Interest rate hikes became necessary, but also slowed economic recovery. In this context, investors began seeking inflation-resistant assets beyond government control. And once again, Bitcoin, with its limited supply and decentralized nature, stood out as a logical solution. At the same time, market sentiment played a critical role. As Bitcoin crossed $70,000, then $90,000, then $100,000, and finally $103,000, the fear of missing out, FOMO, exploded. No one wanted to be left behind. Retail investors returned. Former skeptics suddenly became eager to learn how to buy Bitcoin, set up wallets, and open exchange accounts. As capital flowed in, prices kept rising, creating a feedback loop of growth. The major difference in this rally lies in the maturity of the Bitcoin ecosystem. No longer just a speculative digital coin, Bitcoin now has a robust supporting infrastructure. Second-layer solutions like the Lightning Network for faster and cheaper transactions, internationally compliant custodians protecting investor assets, and DeFi platforms generating yield through staking, lending, or liquidity pools. Moreover, Bitcoin is increasingly being accepted at the national level. El Salvador was the pioneer, but it's no longer an outlier. Several nations are studying how to integrate Bitcoin into their payment systems, or even use it as a hedge against currency risks when trust in the USD, Euro, or their own currency weakens. Emerging economies are quietly but powerfully shifting to using Bitcoin for international transactions to bypass central banking control. However, all growth comes with risks. The first is regulatory. While ETFs are approved in the US, not all countries are on board. Many still view cryptocurrencies as threats to financial stability and are considering tighter controls. A sudden regulation from China, India, or Europe could shock the market in the short term. The second risk is market euphoria. As prices rise too quickly, many investors use leverage, borrowing money to invest. If the market corrects suddenly, a domino effect from liquidated leveraged positions could cause a temporary crash, as seen in 2021. The third risk comes from competing digital assets. Central bank digital currencies, CBDCs, are emerging as potential competitors, especially in the payments space. While they can't fully replace Bitcoin's store of value role, Their rise may shift the balance of power in the digital currency space. So what's next for Bitcoin? Analysts commonly mention three main scenarios. One, the optimistic case. Large funds continue buying, countries adopt Bitcoin more broadly, the ecosystem grows stronger, and the price could reach $120,000 or even $150,000 within the next 12 months. Two, the neutral case. After peaking, Bitcoin pulls back to the $90,000 or $80,000 range for consolidation, then resumes its growth cycle. Three, the pessimistic case. The market corrects sharply due to unfavorable regulations, liquidity crises, or major system failures, pushing prices below $70,000. Of course, no one can predict the exact top or bottom, but what matters most is each investor's strategy. If you're investing long-term, stay consistent with a reasonable asset allocation, avoid overexposure to a single asset, and prepare mentally for volatility. If you're a short-term trader, follow strict discipline, use technical analysis, and don't let emotions take over. And if you're just an observer, this is a great opportunity to learn, explore, and prepare for the future. Because whether you participate or not, the digital financial world is racing ahead. Bitcoin surpassing $103,000 is a symbolic event, not just for investors, but for the global financial system. It's a clear sign that the world is changing, that traditional values are being challenged, and that we're entering a new era. One where control over assets no longer lies in the hands of intermediaries, but in the hands of individuals, fairly and transparently. But that freedom comes with responsibility. Owning Bitcoin isn't just a chance to get rich. It's a test of knowledge, psychology, and investment discipline. To seize this opportunity, you need more than a click. You need knowledge, awareness, and the ability to see beyond the numbers on a chart. We are standing at a historic moment, and whether you are a skeptic or a believer, a major investor or just a bystander, one thing is certain: Bitcoin has, is, and will continue to redefine how the world understands money, assets, and financial freedom.